The U.S. housing market in August 2025 is experiencing something we haven't seen since 2008, but this time it's different and potentially more dangerous for unprepared buyers. Right now, the median home price sits at $446,766, according to Redfin's latest data, barely up 1% from last year. That might sound stable, but here's what they're not telling you. 22.5% of all homes nationwide are seeing price cuts. That's nearly 1 in 4 properties, up from 18% just a year ago. Homes are sitting on the market for an average of 40 days, the longest we've seen in years. But the real shock? First-time buyers now represent only 24% of all purchases, the lowest share since records began. The median income needed to afford that median price home? A staggering $108,800 annually, while the typical American household earns just $96,500. We're witnessing this systematic lockout of an entire generation from homeownership. Jerome Powell himself admitted in July 2025, the real issue with housing is that we have had and are on track to continue to have not enough housing. This is not something the Fed can really fix. When the Federal Reserve Chair throws up his hands, you know we're in uncharted territory. Let me paint you a picture of ground zero. This former pandemic darling has experienced an 18.51% price collapse from its May 2022 peak, falling from $550,000 to $449,900. Some neighborhoods are down even more brutally. Travis County's 78736 zip code has crashed 37.6%, from $750,000 to $468,000. The tech layoffs that started with Google, Meta, and Amazon have created a domino effect. Austin's office vacancy rate has exploded to 26%, with downtown trophy buildings hitting 30% vacancy. The city's new listing to pending ratio dropped to 0.58, below the critical 0.60 threshold that signals market distress. When 65.7% of Texas home sales include price cuts averaging $12,500, you're not looking at a correction anymore. You're looking at a reckoning. But here's what should terrify every homeowner. Texas now has 141,950 active listings, the highest level since 2011. The inventory surge is happening at nearly double the rate we saw during the 2007-2008 housing crash buildup. Builders are so desperate they're offering up to $125,000 in buyer incentives. Castle Rock Communities, Highland Homes, Taylor Morrison, they're all slashing prices and buying down rates to as low as 3.49%. Florida's market is imploding from a different angle, the insurance crisis. The average homeowner now pays $2,625 annually, 24% above the national average, with some counties like Monroe averaging $9,058. Cape Coral Fort Myers has seen prices drop 11% over 2 years, the steepest decline among major metros. With 52% of homes experiencing price cuts and an astonishing 15 to 20% of Florida homeowners now going completely uninsured, we're watching a slow-motion catastrophe unfold. The median Florida home price has fallen to $412,000, down 4% year over year and 4.2% below its April 2024 peak. Naples and Punta Gorda are both down 14.5% from their peaks. When luxury coastal markets that were untouchable 2 years ago are seeing double-digit declines, the contagion is spreading fast. California presents a different nightmare, the affordability crisis from hell. Only 15 to 16% of California households can afford the median-priced home at $866,900. In San Jose, that median rockets to $1.6 million. The income required to afford a mid-tier California home? $237,000 annually. That's 2.5 times the state's median household income. The Bay Area has hemorrhaged 292,050 households since the pandemic began. Tech companies have shed 25,400 jobs since their August 2022 peak, a 19% decline. San Francisco condo prices are down 14.7% from their peaks, single-family homes down 15.4%. Even with these declines, a typical San Francisco family couldn't afford a home there if you gave them an interest-free loan. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. Here's a statistic that should make every potential buyer pay attention. 44.4% of all home sales now include seller concessions, approaching the record 45.1% set in 2023. In Seattle, that number explodes to 71.3%. Sellers are essentially begging buyers to take their homes. Portland sits at 63.9%, Atlanta at 61.5%, San Diego at 60.7%. These aren't just token gestures. Sellers are offering to pay closing costs, buy down mortgage rates, cover HOA dues, and provide repair credits up to $100,000 in some markets. When nearly half of all sellers are cutting deals just to move their properties, you're not in a seller's market anymore. You're in a market searching for its bottom. Glenn Kelman, Redfin's CEO, didn't mince words. He called existing home sales dead as a doornail. Based on current industry data, 60 to 64% of builders are offering sales concessions nationwide, according to NAHB surveys through December 2024, while 31% of builders cut home prices in December with an average reduction of 5%. These incentives reflect ongoing affordability challenges as mortgage rates remain elevated above 6%. D.R. Horton is currently offering 3.99% for the first year and 4.99% for years 2 through 30. 5.879% APR, plus up to $10,000 in closing costs and move-in packages including appliances. CEO Paul Romanowski confirmed the company will continue offering buy-downs even if rates shift down to maintain competitive advantage. About 80% of D.R. Horton buyers choose buy-downs over other incentives, up from 70% in prior quarters. Sales of newly built homes rose 2.6% in 2024, while existing home sales fell to 30-year lows, driven partly by builder incentives. Following the November 2024 election, 23% of builders lowered prices, up from 18% in October, and 75% of projects offered incentives on quick move-in inventory. However, these incentives are compressing builder margins, with the average operating margin for 12 largest home builders at 15.08% in Q4. Markets showing the highest incentive activity include San Jose and Salt Lake City, 81% of projects, while lowest are in New York, 31%, and Chicago, 61%. Builders are offering closing cost contributions, design center credits, rate buydowns typically to the high 4% through high 5%, and flexible financing terms to address affordability constraints in the current rate environment. Now, before you think we're heading for 2008 Part 2, let me share why this is different, and in some ways, more insidious. Current mortgage delinquency rates sit at 4.04% compared to 9.3% at the 2008 peak. Only 1 to 2.7% of homes are underwater on their mortgages, versus 23% in 2009. The lending standards are tighter, the buyers are more qualified. But here's the trap. This stability is an illusion built on a foundation of unaffordability. Lawrence Yun, NAR's chief economist, revealed the shocking wealth gap. Homeowner median net worth is $415,000, while renter median net worth is just $10,000. We're creating a permanent underclass locked out of wealth building through real estate. Federal Reserve Governor Adriana Kugler admitted in July 2025 the cost of owning a home relative to median income in 2023 were at the highest level seen since 1980. Think about that. We've exceeded the affordability crisis of the early 80s when mortgage rates hit 18%. The construction industry tells another troubling story. The NAHB Housing Market Index sits at 39, spending 15 consecutive months below 50 in negative territory. Housing starts have fallen to 1.32 million annually, with 33% of builders cutting prices. Yet despite stagnant permits, there haven't been large-scale construction layoffs yet. Builders are hanging on by a thread, but for how long? So what does this mean for you as a buyer or investor? First, understand that mortgage rates at 6.67% aren't coming down significantly anytime soon. Jerome Powell made it clear the Fed can't fix the housing shortage, and they're more concerned with inflation than your mortgage payment. Major banks are projecting modest scenarios. Goldman Sachs sees 4.4% home price growth in 2025, but they're also bearish on transaction volume, not expecting meaningful recovery until 2027. JP Morgan forecasts 3% growth, while Bank of America cut their projection to just 2%. The consensus? We're entering a prolonged period of stagnation. If you're buying, target markets with the highest seller concession rates. Seattle's 71% rate means you have massive negotiating power. Look for properties that have been sitting for over 60 days. Sellers are desperate. In Austin, where 65.7% of sales include significant price cuts, you can demand the world and likely get it. For investors, the opportunity lies in the chaos. The luxury market, surprisingly, remains the strongest segment, with $1 million plus homes seeing the fastest growth for 21 consecutive months. Why? Because 88% of luxury transactions are all cash deals, insulated from rate impacts. If you have capital, there's opportunity in the disruption. Watch for these critical indicators. When Texas inventory exceeds 5-month supply. When Florida insurance rates force another 10% of homeowners to go uninsured. When California sees net migration exceed 300,000 annually. Those are your signals that the next leg down is beginning. We're not in a housing crash. We're in something more complex and potentially more damaging. An affordability crisis meeting an inventory surge, complicated by insurance disasters and regional collapses. The Fed has admitted they can't fix it. Builders are offering 6-figure incentives, and nearly half of all sellers are making concessions. The smart money isn't waiting for a crash. It's recognizing that the crash is already here in certain markets and spreading. Austin down 18.51%, Florida coastal markets down double digits, California experiencing mass exodus. The question isn't whether your market will be affected, it's when and by how much. As NAR projects existing home sales to reach 4.5 million in 2025, remember that's still far below the 5.35 million we saw in 2019. We're operating in a diminished market where winners and losers are being decided by geography, timing, and most importantly, information. The housing market of August 2025 offers both the greatest opportunity and the greatest risk we've seen in generations. Armed with these facts, these real numbers from the ground, you're now equipped to make decisions that could define your financial future. The crisis is real, the opportunities are massive, and the time to act is now. But only if you're prepared to see past the headlines and understand the true dynamics reshaping American real estate. Remember, in chaos, there is opportunity, but only for those bold enough to see it and smart enough to seize it. The 2025 housing market isn't just changing, it's transforming entirely. Make sure you're on the right side of this transformation. If you found this video interesting, please subscribe, share, and watch this one as well.